Welcome to the daily update where I'll go over the action in the market for Friday, January 17th, and we'll see how things look for Tuesday, January 21st. The markets will be closed on Monday in observance of MLK Day. So we're going to get a little bit of a longer weekend. We've had a lot of 4-day weeks to start 2025, the usual ones, and then we had the one for the state funeral. Okay, we are still turning more positive. There's some things to be concerned about, but the market likes to climb a wall of worry. We're seeing our smart money indicators kind of slowing down and actually turning down a little bit there, but we're seeing the internal things continue to grow. We were able to recapture the 50-period simple moving average for the S&P. That's positive. So we've now switched back to positive in the short, intermediate, and long term. So things are looking pretty good. With that dangerous chart pattern that I'll show you, we might be breaking above that. We did go above it. Now we'll have to see, can we stay above that level? All right, let's go back and talk about what happened. Everything turned pretty strong. Europe was up pretty big, and the futures just started getting better and better and better. And there's a lot of optimism right now with the new administration coming in. The reports that came out this week were a little more inflation friendly. And so the market just decided it wanted to go higher. Now, we were seeing this starting about a week ago with the smart money indicators showing an improvement even on a pretty significant down day. We saw that in Monday and Tuesday session, and that kind of led up to what we saw on Friday. So we can get a bit of a heads up by looking at these smart money indicators, and things turned positive with the futures. We gapped higher. We got above R2 at 59.78. And then we went all the way up to R3 at 6,012. We got above 6,000. Unfortunately, we didn't close above 6,000. Prices then just drifted lower. There wasn't any real convicted selling, but we did just kind of trickle lower, and then we ended up closing under 6,000. Now, it was options expiration. We did see a pickup in volume, not the huge spike that we usually see, but the 6,000 level, there were a lot of options that either were going to go in the money or stay out of the money, and a lot of them could have been at the 6,000 level, which would be right around 600 for the SPY. That there was a lot of nervous folks just holding out, wondering, okay, am I going to make a profit? Am I going to suffer a loss? So it was a pretty tense day from that aspect. But we were up exactly 1% on above average volume. As I said, we are now positive as measured by moving averages in the short, intermediate, and long term. Interest rates went up a bit in Friday's session. They didn't come down like they had been doing earlier in the week. And at least the data that we received this week is more inflation friendly. Of course, there's all the geopolitical things going on, specifically with the inauguration on Monday. That's also a holiday, and folks will be really tuned into what's happening with the inauguration. And then we'll see how everything unfolds that way. So mega caps and growth, they had a good day on Friday. They lagged in Thursday's session. They had been doing better, but in Friday's session, this is where the real strength came from. And we were able to get back above the 50-period simple moving average, which as of Friday was at about 59.66. That adjusts a little bit every day. The parabolic SAR has now turned positive. This is a primary intermediate term indicator that had been negative. It now has a dot underneath, and so that's showing that the situation and the overall condition of the S&P is improving. Smart money indicators, they're still positive for the most part. We have our Chaikin oscillator starting to go down. We didn't go up very much with accumulation distribution, and we're seeing a little bit of weakness with the Chaikin money flow. So we're leaning positive with those right now, but they are showing some weakness, and I'll show you those charts. Now we have kind of our usual list here with the short-term extreme positive indications. Now, on one hand, that suggests that maybe we've overdone it in the short term. On the other hand, that can suggest, okay, we're seeing some good momentum here. Doesn't mean we're going to go straight up, but it just means that everything is leaning more in the positive area of things. So this includes the Stochc RSI, the Williams Percent R, CCI 14 and 20, the stochastics in the short term. And this was on the list after Thursday is the McClellan oscillator for the S&P. In the intermediate term, we have some of our PMO studies. Now, these are studies inside of the S&P. It's the price momentum oscillator. It's developed by Carl Swenlin. And then with that, he's developed some additional studies that can be quite insightful. And no really big change here to our scenario. The Fed's probably done cutting rates, at least for now, until it's proven otherwise that they should come in and cut them. And they've also increased their inflation outlook. And that's what was spooking the markets there for a while. Well, we seem to be getting a little bit beyond that, at least as of Friday's session. It could come back at any time. The dollar was up. That could have also pressured stocks, but it really didn't. Interest rates were virtually unchanged. We were at 4.61%. We were that way after Thursday. We're also that way after Friday with the 10-year yield. We're still coming off that 5% level with the 30 years, so I stopped talking about that for right now. I'll keep an eye on it, and we'll just see if that turns into anything again. Sentiment really ticked up. Now we're still negative, but the context is that we're turning more positive. We had been at 28, we climbed up to 38 in Friday's session, and we're starting to turn positive now, just barely, with our trend. The green line is starting to cross above the red line. It's still a weakening trend though, because the ADX is going down and it's under its moving average. We'll have to see if we actually drop below 20. We're still just barely above 20. And with the update, the bias is positive. And now I've switched our momentum back over to positive. That's kind of a cautious positive. So we are seeing an improvement there. So the reports that came out, we got total housing starts up 15.8% on a month-over-month basis. And this adjusts annually to 1.499 million. That's greater than the 1.318. That's showing economic strength. And that's probably why interest rates went up. Total building permits were down 0.7% month over month. When you annualize that, it's 1.483 million. And that's a little bit higher than the 1.454 million that they had expected. Industrial production up 0.9% month over month, a lot stronger than expected there, up 0.3%. Last time it was up 0.2%. And we were also stronger with capacity utilization, 77.6. They expected 77, which is the reading that we had last time there. And then we had industrial production. It was up 0.5% on a year-over-year basis, but it's 2.1% below its long run average or long-term average there. So it's just meaning that we're improving more in the short term, but we haven't really started to improve more in the long term. So here's some charts. This is the 3-month average of housing starts and building permits where they're both going back up. The blue line are housing starts. The yellow line here are building permits, and that's showing economic strength. This is housing starts really jumped up after we had been declining here. And then production and capacity on a utilization basis, we're coming down with utilization here year over year, but we're going up with production. And that's kind of, you like the idea that production is going up, but we're not at full capacity. There's still room to grow. Usually when we get to that 80% level, that's when it's at full capacity, which is what we show here. We're still under the 79 area. We could go all the way up to 80 before the US economy is considered to be at full steam at that point. And then month over month, we did see a pickup in industrial production. Here's some Isabel net charts. It says timing is everything, and that's why I do technical analysis. It's okay, we're up 70% of the time, we're down 30% of the time in the long term with the markets. But if you get in at just the beginning of that 30% downtime, that can really be a killer. What you want to do is try to be able to figure out what the charts are saying to say, okay, let's take advantage of that 70% time. And then when we hit that 30% time, we either get out of the market and go to cash, or we take advantage of those downward movements. And that's really what they're trying to show here, is just that there are different times. Now, there's the other side of that coin, which is just dollar cost average, long term. Long term, it will go. Well, if you don't really have time on your side, or if you want to protect what you already have, then you need to implement some different things that I talk about in my courses. Then, when we do have two up years in a row that are up over 20%, it's not necessarily a reason to be bearish. We tend to underperform here. The average is 12.3% in the third year after 20% back-to-back years, and the median is 2.8%. I mean, still, that's a really good return. But if we end up following what the statistics show here, then we'll probably underperform in 2025. And there's also some other charts that we've looked at that say that the first year of a new presidential cycle can often be weak, especially in the face of having two good years back to back. Then the mega caps and tech positioning, we're seeing that it had been coming down because this is before we started to go back up. And then Deutsche Bank thinks that we're going to go down even more here. Right now, we're kind of going in the opposite direction. But earnings, which are really hard to see in this chart, they expect the earnings to come down, but the buying to actually continue to go back up. We'll have to see how that plays out. And we get this chart roughly about once a week. These are the seven largest stocks in the S&P. They make up 34% of the index. That's why we follow them. And then this is comparing how much in Europe do households own stock? And it's a lot less in Europe than in the US. And that's kind of the historical picture that we've seen where it's very common for people in the US, in their house anyway, to be involved in the stock market in some fashion. It may be your retirement, you may have your own portfolio. It's less common in the UK anyway, and in the Euro areas. All right, diamonds are not forever. Okay, the price of gold has soared while diamonds have slumped. I guess Marilyn Monroe, they're not her best friend right now. And this is after retail sales coming out. We're starting to go back up here with the reading, where typically what we'll see is a real flattening out before we go into a recession. We did flatten out here for a while, but to this point, we have not gone into a recession, and now we're starting to see this bounce back up a little bit. We'll see if that can continue. I looked around Twitter, but didn't really find anything all that interesting. So let's go over to the intraday chart. And because Thursday's session was so anemic as far as price movement, we got above R2 pretty easily. And I had to break out the pivot point calculator, and we made it all the way up to R3, and that was pretty much the high. Now that was above 6,000, but then we came back down below 6,000 and did close under that level just a little bit. So most of the gains were seen in the gap, and then we just kind of drifted after that. And then we're closed for the weekend now. Not much of a change in the futures, but what had happened is we were actually negative here with the futures, and then Europe opened, and Europe was having a really good day. That bumped up the U.S. futures, the S&P futures, and then that just came over into the cash session. And you can see while we're still in this blue area, this is before the market opened, and we saw a lot of strength, and that produced the gap higher that we saw. Still looking good here. When we see the blue line above the red line, that means intraday. Large cap growth is outperforming large cap value. We're still holding up fairly well here, not really breaking to the upside. But when we look at S&P growth to value intraday, this is still looking solid and has been looking good since the end of November. End of day, growth was up. It had a good day. Value was up, but up about half as much here. And then the mid caps growth was up a little bit more, and we were up more with the small caps. So looking at our small cap growth to value ratio end of day chart, this is still looking good. We have been going sideways with the small caps, then they started to go lower. Are we finally starting to see some kind of a sustained upward move? Now, again, you look at the bar chart here, we opened and closed at just about the same level, but you could say that for the S&P too, because most of the gains were seen in the gap that we saw. Also seeing a little bit of a turn back up with mid-cap growth to value. They're also showing some improvement, but still running into their 50-day moving average. S&P growth to value also looking strong in an uptrend as well. And this is more positive for the market. And going back up a little bit, we came back down into the rainbow when we look at the growth versus value ETF. And the ratio is not really breaking out to the upside, but it did improve a little bit in Friday's session. This is one of the stronger areas right now. Discretionary to staples, discretionary is outperforming, and that's also helping the market. Large cap growth is still above its 50-day moving average, so this is showing an improvement after we had fallen under the 50-day moving average. As far as our trend, it's really hard to see here. You have to look over here at the numbers, and you see the green numbers are a little bit higher than the red numbers. That means the green line's crossing above the red line, but we're still declining because the ADX is picking up a potential change in trend here, and so that's weakening until this trend gets a little bit more established if we can continue to go up. So we're below the moving average, but we're still above 20. And in the short term, we're seeing a cross from green going above red, but we're still declining. We're just barely above 20 with this. So it's still a weakening trend. And we were above average with volume because it was options expiration. Sentiment, we're coming down, but we're still above the moving average with the Ulcer Index. Coming down with the VIX, it didn't decline as much as maybe you would think, but we're still seeing this coming down overall, both with the line chart and the bar chart. And the VIX of the VIX actually picked up. Usually they tend to go in the same direction. In Friday's session, they both went up. And we are seeing the momentum for the VIX now switching to down, using the MACD as a momentum oscillator. Still getting a high reading here. We'll see if this changes after Friday since it was options expiration, but this this includes Friday, but we'll have to see what happens when we get another day beyond this to see if this ends up changing. And we're going down with this fear gauge. We also declined with this other fear gauge. So even though interest rates were going back up, we are seeing a real drop off in fear this way. These were not updated yet, so I can't really show much here with our equity put call ratios. I waited and waited and they never updated here. So I just kind of have to slowly go through these since they're one day late now. But we are seeing a real drop off in fear here when we look at volatility risk premium, and that could end up being more positive for the market. We're improving, but not back to these previous highs yet with the advanced decline line based on price and volume, but they are both going up and they're both above their moving averages. So they're looking more positive. We are seeing an improvement here, an expansion of the new highs, a contraction of the new lows. Our 5-day and 10-day moving averages are now going back up. And we're above zero and advancing in the short and intermediate term with the advanced decline ratio. And we're actually, we went up a little bit here, but you would think with a solid day on Friday, the accumulation distribution, which is a smart money indicator, that it would have gone up more than it did, but it really didn't move all that much. And we're seeing a little bit of a drop off. We're actually turning back negative with the Chaikin money flow. This is a little bit of a concern here. We're not quite rolling over with the red line yet, but you would think this would have gone up on a solid day. It actually went down. And the Chaikin oscillator is now going down and just possibly starting to drop below its moving average. So a week ago, this was giving us hope that things would look better. Now we're seeing a little bit of weakness here. Is this going to cause us some concern going into next week? The vortex is still negative, even though the red line's going down, but the green line's going down too. And so we look at the cumulative advanced decline line for the S&P, and that is improving. And we're also going up based on volume. So both price and volume are improving, but we're right about back to this previous level based on price. We're breaking out a little bit more, excuse me, based on volume. We're breaking out a little bit more based on price. This is looking more solid. We're actually starting to get kind of an extreme reading, which could suggest good momentum. This is the advancers minus the decliners and a 10-day simple moving average. This had been improving and continues to do so. And the NYSE advanced decline line is improving. It bounced off of its 200-day moving average. Now it's coming up to deal with its 50-day moving average. And our NYSE cumulative advanced decline line breaking out, setting a high here, but we still haven't come back up to the moving average with our regular NYSE advanced decline line. We're still below it with this other NYSE advanced decline line. We need to get back above this moving average, stay above it, see the moving average start to turn back up to be more positive longer term. And we saw an improvement with the common stock on the NYSE based on price and volume. Improving here with our 10-day average of the highs and lows for the S&P. We're not above 50 yet, but we are bouncing back up after we had really been dropping. And we're seeing an improvement with our advanced decline line studies. We're back up to the moving average with the NYSE common stock, just a little bit above it with the S&P and the mid caps, improving but still below the moving average with the small caps. This is more positive though. With the stocks inside the S&P above their 20-period moving averages, we've now crossed above 70. This is showing pretty good short-term momentum. So this is our next chart where I've been trying to point this out, where we came down in December and we had a pretty negative reading, and then we tried to go up and we came back down, but we had set a higher low. Then we went back up and came back down, set another higher low, and now we're seeing a pretty good thrust up out of this, enough to cross back above 70. And other times, especially last spring, when we saw a similar situation to this, when we went above 70, that led to some good action for the S&P, at least for a while. Now, it doesn't mean that we're going to go straight up. Excuse me, but you have to take this in the bigger picture. We did have pullbacks along the way, but overall, we spent a considerable amount of time up until the summer when we set all-time highs, mostly going higher during that time. And we're improving with our 50-day moving average study, but we're still below 50. We're just about back up to 50 with our 100, and we're improving, and we never dropped below 50 with our 200, even though we were kind of flat in Friday's session. So short term, we're back above the 50-day moving average, and we're back above this pivot point that we have here for the month of January. And that is positive. When we're above the pivot point, that means the bias is more positive. When we're below, that's more negative. And we were above average with volume. This is that dangerous chart pattern I'm talking about. For right now, it looks like, okay, maybe we have been able to break out above this. Now, can we stay above it? Can we add to this, negate these previous highs? Because we haven't really gone up beyond these previous highs yet, but we are at least breaking this trend line for right now, the series of lower highs and lower lows. So this is improving, but we still need to see this go up to have it turn even more positive. And we're looking good though when we look at moving averages with the 20, 50, and 200. We're actually kind of flat with the 200 though. We're getting extreme positive with the Stochc RSI, which could mean overbought. It could also mean that we're starting to see good short-term momentum because we can come up to this area and stay here for a long time. Also getting extreme with the Williams percent R, we can also stay camped out in this area as well. The CCI 14 is starting to get extreme, as is the CCI 20, but these can come up here and even go higher than where they're at right now. In the short term, the stochastics are looking extreme. Now, this is short term. Intermediate short term, we're positive and we're turning back up, but still below the midpoint with our long term stochastic. The force index improved, so that's positive there. And we're looking a little more positive with the short-term trend. We were able to recapture the blue line and the green line, and now they're starting to turn back up. And that is showing an improvement here. We're above the 20-period simple and exponential moving averages. That's an improvement as well. That's why the short-term trend is positive. We went up here. We're above the midpoint with our standard deviations chart, but we're still in the +1 channel. This is interesting, though. The balance of power, though, it's picking up something it doesn't like. It's continuing to be negative. And we're improving here. We have a brown bar with the no-go node, but it's not switched over to positive yet. But this can redraw at some point and change color. It's like a chameleon. And we're above the midpoint and going up with our highest high value now, but we haven't come up to this blue line at least yet. And we are improving with the TTM squeeze, lighter shade of red, and it's starting to come up. We could turn positive here pretty soon if we see more follow through. And now we're picking up steam here with the standard deviation. This goes back over the last 10 periods. This doesn't measure direction, it measures speed. And when we start to go above the moving average, that means we're moving kind of fast. And really no improvement with the ease of movement. We're still negative with this, and it was flat in Friday's session. The Arun was also flat after giving us an extreme negative reading. It bounced up off of that, but no change on Friday. The McClellan oscillator still showing good short-term momentum, but we're above the 60 level, which sometimes can mean we're maybe overdoing it. We're going back up with the summation index based on price and volume. That's positive. And we're going up and not extreme with the NYSE McClellan oscillator. That's positive. So we're going back up with the summation index based on price and volume here. So we're seeing some improvements, not only in the S&P, but in the broad market. The Swenlin trading oscillator continues to be positive based on price and volume. Momentum is trying to improve. We haven't quite crossed above the moving average with the PMO, but we're well above it and now going up based on price, and we're lagging a little bit here based on volume. And this is where we're extreme. With the PMOs that are rising, we're getting above this green level, which could suggest good momentum. These are all the PMOs inside of the S&P. The buy signals are going up, and we're flat to slightly going up here with the PMOs above zero. Momentum is improving in the short term. The slope oscillator is actually turned to positive. It'll be even more positive if we cross above zero. And the MACD is now crossed above its moving average. So that's gone from negative and improving to now positive. So all of our oscillators in the short and intermediate term are improving. And with the exception of the PPO, we have not crossed above the moving average yet, but the MACD and the PPO have. We're turning up a little bit with the tricks and the KST, but we haven't crossed above the moving average. Those are our long-term oscillators. The copy curve is now a little bit further above its moving average. That's positive now. The Sean trend meter coming up into this green area, showing that the trend is positive. We're improving, but still below 50 with the money flow. We're above 50 and advancing with the ultimate oscillator. We're above the moving average and going back up with on balance volume. We're back above 50 with the RSI 14 and the RSI 9. The RSI 9 is short term, the RSI 14 is intermediate term, and that's switching the momentum back to positive. And we're right up to the blue line here with the 50 period study looking at the intermediate term trend. If we can get above these lines and stay above them, that will turn the lines back up. They're already flattening out. And we're back above the 50 period simple moving average. It had been acting as overhead resistance. We gapped above it and never came back down to it in Friday's session. So we're back above all the moving averages now, the 20s and the 50s. Now they're jumbled up because the 20s were coming down and mingling with the 50s. If we can continue to go up, see these lines turn back up, that would be more positive. And here's a big change. This is the parabolic SAR. We had the dots on top. Now we have a dot underneath. So that has changed from negative to positive. We're still positive with the Elders Impulse system for the S&P, and the Pring bottom fisher is still generating a buy signal. And we're watching the mass index. 2 out of the 3 criteria have now been triggered. We're waiting for this to come back down to trigger the third part, and we'll see what happens at that point. The bullish percent index continues to improve. It's still below 50, but it is positive because it's above the moving average. We're going back up with the NYSE BPI, and we're actually crossing back above 50 with the NASDAQ 100 BPI. And we're above this little mini rainbow here. This is the 20 period, excuse me, simple moving average of the open, high, low, close. This had been acting as overhead resistance. We would get up to one of these lines, and that's about as high as we would go. Now we're finally starting to break above that. If we continue to go up, these lines will turn and start to go back up as well. And we're coming up out of the cloud now with the Ichimoku cloud, but we're still seeing the blue line below the red line. The green line is going up. So this hasn't, it's improving, but it hasn't quite switched to positive. It'll be more positive if blue is above red. And this is some overhead resistance that we may have to end up dealing with. This is the upper end of this trend channel going back to 2009. We hit that and then started to come back down, and we're going to see. Can we get back above that this time if we see more positive action? We're still seeing a mixed picture, though. The Heikin Ashi is positive. We're red, that's negative, but we're pointing up with the keggy, so that's mixed. We're still going down with the Renko chart, and we're still going down with the three-line break chart. Excuse me here. But we did see another X drawn in. Now, this is looking a little bit vulnerable. If you just look at this, you go, okay, we came up this far and then went down. Came up this far and went down. Came up this far and went down. We're back up to this point again. Is it's picking up a bear trap, okay? Meaning that we're going back up, but we haven't exceeded this. We're going to need the point and figure chart to show more X's going up to break out of this possibly negative pattern that we're seeing here. Long term, though, we are seeing an improvement with the 150, and we're pretty much flat with the 200. So we're positive in the short term with all our stock indexes that we follow. We're still negative in the intermediate term with the small caps. And why I'm showing this same chart. Okay, there. If you didn't see it here, you can see it again here. I forgot to add the other one. All right, and then what's interesting is that the three areas that are growth, tech, discretionary communication, and then financials, these four areas led things higher. And that's what we want to see in a good, solid environment. What's also interesting, real estate and healthcare, these tend to be more defensive, especially healthcare. That was the weakest area. And there was some news coming out about a big pharmaceutical company that was not taken as well. Awful lot of blue or green here, where Canada, they're partying it up there with the bullish percent, excuse me, a bullish MACD crossover. The S&P also had a MACD crossover, and that's what we saw when I showed you the MACD chart. And then we have the NASDAQ going above 19.4, 19.5, 19.6. Canada got above 25,000. We did get above 6,000, but we didn't close above 6,000 for the S&P. And then the BPI crossed below 50 with energy. That's seeing a little bit of weakness now. And then we got up to 19.7 with the NASDAQ. And so we are seeing an improvement here, but the red line is still underperforming the bar chart. That means that the equal weight is improving quite a bit, but we wanted to come back up to the bar chart to show that they're performing more in line with each other. And the Dow's right at its 50-day moving average. So that has not been recaptured yet, even though we're above this pivot point now. And we're still positive, though, with the Elder's Impulse system for the diamonds. But you can see these bars open, high, and then close down here, where we open and close and we have a bar that's all off by itself. We want to be aware of that because we're seeing that on the S&P as well. The NASDAQ is above this pivot point. It was able to hold above its 50-day moving average. So this is looking better. We're also above this pivot point with the NASDAQ 100 and also above the 50-day moving average. We're after neutral, we're now back to positive, but you can see we opened and then we went down and then we closed. We closed lower than the open. So there's a little bit of warning sign with what we're seeing here. Momentum for the NASDAQ 100 is improving, but we have not crossed above the moving average. We're still above the plotted moving averages here. So those were recaptured with the triple Qs. The longer we can stay above these lines, the more this blue line will start to turn and go back up if that's what happens. Mid caps hit small caps hit overhead resistance right at their pivot. They have not crossed above their pivot yet. So even though they were up over 0.5%, we would still like to see more of an improving picture here. And we're above 50 now with the Russell 2000 small caps. When we look at the RSI, we're still below the 50-day moving average, but the momentum has switched over to positive for the small caps. And we're still positive with the Elder's Impulse system for the small caps. Mid caps, just a little bit above their 50-day moving average. So I was incorrect. It was another index that is hitting its 50-day moving average there. But we're still positive, but we closed well off of the open for the mid caps. We did recapture the 50-day moving average with the Wilshire. This had been acting as overhead resistance. We were able to close above that. That's a broad market measure, and we're back above the 50-day moving average with our total U.S. stock ETF. So that's positive too. The banks have not been able to get back above their 50-day moving average, even though they're seeing some good earnings coming out here. And the financial sector, though, it's actually stronger. It's above its 50-day moving average and was pretty strong in Friday's session. The FANG index was using the 50-day moving average as support, and we've been bouncing back up off of that. These are the really big stocks. That's positive for the market. And we're coming up off of this longer term trend line now. So that support level has been holding to this point. Apple was up 0.75%. We were up 2.39% with Amazon. Google was up 1.6%. Meta was up just a measly 0.25%. Microsoft was up over 1%. It got back above its 200-day and 50-day moving averages. Nvidia was up over 3%, still dealing with its 50-day moving averages. Tesla was up over 3%, looking pretty solid again there. There's some rumors going around that Elon Musk may try to buy TikTok with all the stuff going on with that right now. And then Netflix is not back up to its 50-day moving average, but it was up 1.87%. Semiconductors, we're still kind of concerned about this. We are positive. We're above the 50 and 200-day moving average, but we haven't broken out above these recent highs. We tried to, but that ended up being a fake out. Will it be different this time? And here's where we see it, because this is on a closing basis. We're not quite back up to these previous highs yet. It's going to turn more positive if we can get above this. We've hit this point before and then turned and came back down. And the Dow Jones Semiconductor Index, it was up over 3%. That's looking pretty solid. The SOX index is still in a downtrend, but we were able to get back above the 200-day moving average. And the ratios, semis did outperform tech. If this ratio continues to go up, that would be even more positive. That means the semiconductors are leading the tech sector higher. And if the tech sector is leading going higher, then the S&P is going higher as well. And we're seeing a bit of a flattening out here with the short-term correlation between world stocks and US stocks, but the longer-term correlation continues to improve or get stronger. We're still getting some kind of high readings here with oil, even though it was down over 0.5%. The dollar still giving us very high readings overall. It was virtually unchanged. We're in the 109 level now. And we're going back up a little bit here with the 10-year yield. But if you look at this, this actually looks kind of positive. We hit a top, we're coming down, we're setting a series of lower lows and lower highs here. We just closed a little bit higher. The building permits and the housing starts, that kind of spooked the bond market a little bit. And we were actually up a little bit here based on price as well with this ETF. Seeing an improvement here when we look at the ratio between home construction and 3 to 7 year bonds, but we're still below this 250-day moving average. And coming back up to the 200-day moving average and still kind of right around that level with the total bond ETF. And seeing a little bit of improvement with the Qs to S&P, we're right back up to the moving average. Discretionary to S&P, a little bit above the moving average. We're still under the moving average when we compare large cap growth to large cap value. So with the large caps, we're under the moving average. We're on the moving average with the mid caps, and we're bouncing up a little bit with the small caps. So what's our outlook for Tuesday? Remember, we will be closed on Monday. We're starting to come into earnings season now, and that's going to be a driving factor. Technically, we are turning more positive. We're showing an improvement here, and we were able to get back above the 50-day moving average. We will be closed on Monday, and then we're not going to have any reports on Tuesday, so it's going to be a little bit lighter there. The market will be left to its own devices. And then all the geopolitical things, with the big thing being the inauguration on Monday, and then the observance of MLK Day. That's all happening at the same time. Here's the economic calendar. We're not going to have any reports on Tuesday and not really much of anything on Wednesday. The big report this week will probably be initial jobless claims and continuing claims. And just highlighting this, that the market will be closed on Monday. Seasonally, not much of an edge either way. We're neutral to negative with the Dow and the NASDAQ, and we're neutral to positive with the S&P. Now we're going into the week after options expiration for January. And oh, good, I didn't change the date on here. Isn't that nice? but we're up 62% of the time and down 38% of the time going back the last 21 years. But disregard this December up here. This should be January 20th through the 24th. And then not really much in the way of seasonality in a post-election year with the green dashed line for the S&P. Now we're into the second half of January, which tends to underperform the first half, but the first half really didn't do all that great. Small caps, can they get some fire under them and continue to go up? We've been faked out numerous times over the last year, and now we're coming into more of the negative time, according to Tom Bowley's research. So we're actually a little bit concerned about the smart money indicators right now, with accumulation distribution not really showing any strength. The Chaikin money flow is actually declining, as is the Chaikin oscillator. So we're not seeing any strength right now. But I'm taking this right now anyway, that we're not switching over to negative. We're just seeing a lack of strength right now. We are still negative with our advanced decline lines, but they are improving. And then this is in italics because the charts weren't updated. The vortex is still negative. Now, I should have taken the 20 off of here because we're positive, but we're still below 50 with our 50 and 100 period moving average study. And the ease of movement is still negative. The money flow is negative, and the NASDAQ 100 momentum is negative, but improving. The positive signs, we're still looking pretty good when we look at our growth to value ratios. Discretionary to staples, also looking pretty solid right now. We're still extreme with the S&P McClellan oscillator. We're positive with the NYSE McClellan oscillator, but we're going up with the summation indexes. So that's positive there. We're improving. We're turning positive now with momentum. Parabolic SAR is now positive. Swenlin trading oscillator is positive. The bullish percent indexes are now positive. And we never went negative with the 200-day moving average study there. And the ultimate oscillator is positive. The financial sector is positive. So our conclusion, not much to really change at the bigger picture. We are in the process of possibly turning positive and seeing signs of improvement because the large caps and growth are holding up fairly well right now. We are positive in the short term and improving, and now our list is showing either good momentum or that maybe we've overdone it kind of quickly. And now we have switched back over to positive in the intermediate term because we got about above the 50-day moving average, and we remain positive in the long term. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.